Alright, this is Jeremy Burgess, the Detroit Market Expert. Every single occupation in this world, be it a pipe fitter, if you work for Comcast, if you're in the finance world, you have your own lingo. And some of that lingo is confusing, especially the military, by the way. I just know a ton of it. Real estate is no different. In fact, in some ways, it's worse. Now, this is not going to be comprehensive. I'm going to go over a bunch of acronyms and give definitions to commonly used definitions and acronyms in real estate. All right, and we're gonna go fast because look, I got 2 pages. So the nice thing about watching a video is if I speak too fast for you, just go ahead and go back and do it, because I'm not trying to make this thing an hour long. So, and I kind of put it in order, but you know, some of these you know, some of these you don't. Doesn't matter. I'm just trying to cover the basics. So what we have is ARV, which is after repair value. I'm not going to write it. That's the nice thing about video. It's after repair value. After repair value is you buy a house, needs rehab, you do the work. What's it worth after you do the work? CMV, current market value. Current market value could mean after repair value too, if it's repaired, or if it's in a state of repair, what its current value is. Fair market value. It's pretty much either one of these. I know it's confusing. Fair market value could be after repair value, or it could be current market value. I swear to God, they just make this crap up to confuse us too. ROI, return on investment. That's generally your net, your net profit divided by your total investment. And if you want, you can throw in, you know, some sort of financing as well. NOI, it's your net operating income. That is, could be expressed either monthly or annually, usually annually. BPO, broker's price opinion. It's like a down and dirty appraisal, or the next one, CMA, competitive market analysis. It's probably the closest thing to an appraisal, but you're using a realtor to do it. I actually covered that in another video. COC, cash on cash return. I use ROI a lot of times when I mean cash on cash, but not as many people know what cash on cash is. And in my opinion, an ROI can also not include financing, although people view it differently. Cap rate. Cap rate is generally commercial in nature. Let you know what you're going to net out, usually with financing, although I suppose you could do a cap rate without financing, and what your annual rate of return is going to be. So, cash flow. This is after all expenses, generally expressed by month. After all expenses, financing, everything, property management, what you're going to make per month. All right, PA. Purchase and sale agreement, commonly known as, or a purchase contract, or whatever. That's the, you know, you want to buy a property, you got to fill out a purchase and sale agreement. Those are the docs you do that for. EMD, earnest money deposit. When you fill out your PA, you usually have to give an earnest money deposit, or at the bare minimum, if the offer is accepted, they expect you to send your earnest money deposit, and that varies. It could be as low as $500, could be as much as $15,000. It's negotiable. POA, power of attorney. Let's say you need to get some things done. Did you, you know, you can't do yourself. You give somebody else a power of attorney to do certain things for you. LOI. This is mostly commercial, but it's letter of intent. It can also be used for single-family homes. Also, if you're dealing with banks, a lot of times they want a letter of intent instead of a purchase and sale agreement to start. All right, warranty deed. Now, I was going through the deeds. Oh my God! See, real estate is local. State, I should say. It's by state law. So every state has a frickin' different name for everything. Realize that most of my investing has been in the state of Detroit, and I did do some in the state of Washington. So I'm not going to be able to cover all the deeds, but generally speaking, there's 3 kinds, and there are technically 4 kinds, whatever. There could be a lot. Warranty deed, which is the highest. Sometimes this is called a special, or no, warranty deed. Yeah, warranty deed's the highest. Then there's a covenant deed. You can't read my handwriting, that's okay, that's why I'm talking. This is also sometimes called a special warranty deed. Basically what a warranty deed is they cover, when the seller's selling you the property, they're agreeing to defend you against all other interests in the future against that property. What a covenant deed is, or a special warranty deed, depending on where you're at, check your local laws, talk to your local real estate agent, a smart one, is they're warranting it from the time of their possession of that deed till the time they give it to you, which is actually, not all that useful. And then you got quit. We say it so fast, we say quit claim deed, but it's actually quit claim deed. And this is the lowest level. This warranties nothing. All it does is transfer interest that somebody may have or in a property to you. No warranty whatsoever. NDNC, non-disclosure, non-circumvention. I almost never sign these because signing these is a total crock of crap. But I have done it a couple times with a bank, and I really wanted to buy this bulk list of properties, which actually didn't end up happening. But this is basically like a 10-page agreement saying, I'm going to give you some information. You can't disclose it, and maybe they're a middle buyer. You'll see this a lot when you get those, they come out of some sort of new real estate training and they want to go lock up properties, and they're so concerned about losing the deal or somebody's, going around them. They want you to sign one of these. So they don't want you to disclose certain information, or they don't want you to circumvent someone in the chain between you and the properties you want to buy. Appraisal. I told you I'm not doing this in any particular order. They're licensed appraisers who go out and give you an appraisal, which could be an after repair value, current market value, fair market value, value on the property. All right, a flip. A flip is when you buy a house, typically rehab it, but not necessarily. So you buy a house and you sell it to a homeowner with conventional financing, right? Wholesale gets more complicated. Just like the word sounds, you're buying below value, selling at a higher value, but typically less than what the after repair, current market value, fair market value of the property currently is. Or you can add value in some way, shape, or form. Wholesale. Wholesaling is when you buy a property that needs work, but it's not significant work. Typically, basically what you call paint, carpet. Maybe you need, kitchen's ugly from the 70s, but still works. Basically, it's a property that's in financeable condition. I mean, there's no issues that the bank would have a problem with, but it's not the prettiest property you've ever seen. And what you do is you buy it, instead of wholesaling it, you'd wholesale it to a homeowner with conventional financing. Turnkey wholesale. I do a lot of this. It's where you buy a property, you turn it to cash flow, and you sell it as a package. All right, closing. This is a very general term, but we use it a lot, at least in Michigan. Closing, generally, it designates the complete transaction of selling a property from one person to the next. And generally speaking, 99.9% of the time, it involves a title company. All right. The HUD 1, Housing of Urban Development. Why do we care? Well, we don't. They can screw up a cup of coffee. However, it's important to you because the HUD 1 is going to be those 2 pages that break down all the expenses when you're buying or selling a property. It's going to have things like title insurance on there, what you're selling the property for, was the title company charging you, earnest money deposit. So HUD 1 is very important. Assignment. There's lots of different assignments, but generally speaking, an assignment is just a transfer, essentially of paper. Most people know this as You go out, you put a property under contract, and that with your purchase and sale agreement. In that agreement / contract, you're allowed to assign the contract for any fee that you want, whatever you can get, to another party, and that party actually closes on the transaction. You don't. Maybe you have an earnest money deposit, but generally speaking, you don't even have that. The person you're assigning the property to would, and then you get paid directly off the HUD. You bring no money to the closing, essentially. All right, double closings and simultaneous closings. I get this question all the time. Double / simul. They're the same thing. Like, what? We have two words for the same thing? Yeah, welcome to English. We do it for a lot of things. Get used to it. Double closing and simultaneous closing is you're buying the property the same day you're selling the property. I need to take a moment here to give you a little diagram too, because people get confused. They're like, what? That's not legal. Yes, it is, because you're using your dollars to buy. This transaction happens first. Then your buyer's dollars is coming in to complete this transaction. And it just so happens to happen on the same day. See, that's the important part to notice. Your dollars buy the property. Then you transfer the deed. Then the buyer transfers the dollars over to you, all via title company, okay? What's illegal? You cannot, at least I don't know of a state, correct me if I'm wrong, you cannot, and there are some exceptions. I think if you disclose it and it's not financed, sometimes you can. But you cannot use your buyer's funds to complete your side of the transaction and then make the money. If you're in a situation like that, you need to go up to an assignment. You might want to clear that up. Seller financing. Sorry, I don't print well because I grew up when they actually used to teach you cursive. For some reason, I'm like the last fool alive at my age bracket, besides my wife. But she can't even read her own handwriting, so I'm not sure if it counts. But that's neither here nor there. Seller financing. Getting the stink eye now. Seller financing is you own the home, and then you sell it to somebody on what you would call installment payments. Meaning your buyer of the house is agreeing to pay you a certain amount over a certain period of time, with a certain number of monthly payments with a certain amount down. Basically, you're acting the bank. And there's a lot of ways you can act as the bank. You can do it via a mortgage. And you can't have a mortgage without a promissory note. Two or one, they go together. Like, what? That's confusing. No, it's not. So the promissory note is what your buyer signs. The mortgage is what secures the promissory note. There you go. Then you can use a land contract. Like, what's a land contract? Well, it's also called a contract for deed. And probably 16 other things I don't know about. But there's one the same. This is a little different because in this situation, you're actually, here, picture time again. So, in the mortgage promissory note situation, here's you, here's your buyer. In this situation, you're starting out, you have the deed. You're going to transfer this deed to the buyer. You're actually doing the transfer to the buyer. In exchange, the buyer is signing a promissory note, and you're filing and you're getting back basically a mortgage, which is filed down at the county, securing your interest in the property. That's very different than a land contract or contract for deed. In that scenario, let's see why I like them so much. In that scenario, you keep the deed. Your buyer signs a land contract. You keep the deed, you have a land contract, and all your buyer gets is what's called a, well, technically nothing, but I don't like that. That's not how I roll. Is a memorandum of land contract, which is filed down at the county, which shows that the buyer has an interest in the property, but you haven't transferred the deed. That's the important difference here. Okay, so let's say you wanted to, you have this mortgage, you want to sell this mortgage. What you do is you'd sell your mortgage and your promissory note at the same time. You would assign the mortgage, and you would allonge, which I don't know where that comes from, probably some French crap. The note, which is used fancy words for transfer, but like any industry, we got to create our own words for because I guess we can. Same thing with the land contract. No, you would launch the promissory note, you sign the mortgage. I promise. My wife was disagreeing with me. But the land contract, if you want to sell, because this is paper, you can sell it. I do this all the time. It's called an assignment of land contract. So, I'm not going to write that one down. All right, so here we go. Option. What is an option? An option, if you're familiar with stocks, it probably makes more sense to you, but if you're not, an option, you can option a piece of real estate, be it have a house, bare land, commercial. You go to the person who currently owns that real estate and say, I'm going to give you a certain amount of money. In exchange for that, I want the right to buy the property at a set price within a certain time frame. That's what an option is. Lease. I'm sure you've all done that. It's where you rent a property from a landlord. Lease is the agreement. When you're going to pay, what's the landlord going to do, what are you going to do, how much you pay, where you pay it, all that. Lease option. Just like it sounds. It's a lease, and you give them an option. It's not seller financing at all. You're renting the house to them, and you're giving them an option to buy the house with the time limit. And usually this option is not recorded, but sometimes it is. But it's a pretty low level form of control. SFH, single family home. Multifamily. This is, single family dwelling. Too. I just remembered that. Sorry. Single family dwelling. Couple bedrooms, bathroom, only intended for one family. Multifamily. This is generally referred to, this is not hard and fast, but 2 to 4 units. Think duplex, triplex, quadplex, something like that. I just barely scratched the surface. Foreclosure. You probably know what this is. Foreclosure happens one of two ways. This is where a lien holder, be it mortgage, land contract, whatever, the person who has the mortgage or land contract didn't do what they say they're going to do, and they're going to exercise their right to end their interest in the property. It's either done, and I'm not going into this specifically, but it's either done judicially or by advertisement. Just remember, you're watching this because I know this stuff, not because I know how to spell. All right. Deed in lieu of foreclosure. This means either you contact the bank contacts you. For whatever reason, you guys come to some sort of agreement. And instead of going through either a judicial or an advertised foreclosure, you're going to sign the deed, your interest in the property, back over to the lien holder and give them the keys. All right? This could also come for, I'm going to say cash for keys. Maybe you pay your bad renter $500 to give you the keys and leave peacefully. Or there's been many instances where the bank is paid. Because I've done cash for keys several times because a lot of times it makes financial sense. Instead of going through with the entire cost of a foreclosure or an eviction, you give them some money, typically less, than what it actually costs for you to do it, but also saves you time. And they, they give you possession of the house and maybe a deed in lieu of foreclosure too. All right, short sale. This is before the foreclosure process. This is during what's sometimes called the pre-foreclosure, meaning and it can happen anytime. I'm just saying generally. Well, anytime before the foreclosure actually happens. Person's down 3 payments at least. A lot of times it's happening more and more now, and you're not doing short sales now, you're missing out. There's a seller and a buyer. You're the buyer, you're buying from the seller. You work with the bank, or a real estate agent works with the bank to agree upon a price that's less than what's currently owed, hence the short, to sell the property so you can skip the foreclosure. That's all it is. All right, CO, certificate of occupancy. Depending on where you're at, you got to get one of these, and it can be hard. But basically, your local government, your city typically, sometimes your county, but almost always your city, comes in after you've done a rehab and inspects your repairs and make sure everything's up to code. And then we'll give you a certificate of occupancy so you can rent or sell your house. Title commitment. Think of this as dating. Title commitment is dating dating a property. You're buying a property, you're using a title company. They pull title. They find nothing wrong on title, or sometimes they do, and then they try and slip it in the title commitment, and then they give you a title commitment. And in this commitment is everything they say they're going to insure you for. And if there's anything erroneous or they don't want to insure you for, they'll throw it in too. Read your title commitment. Title insurance. This is the marriage. Or actually, this is the engagement. Title insurance. You agree, they agree, everybody's agreed, they're happy on the title commitment. You're going to get title insurance. They don't give it to you right away. Why don't they give it to you right away? Because they're sneaky bastards. They run down and they file it. After they file the deed, warranty deed, or special warranty deed, covenant deed, and they get it back, then they give you a title policy. Phew, we're still going. POF, proof of funds. If you're buying a property, you either need to show a commitment from a lender to lend on the property, which is pretty much worthless now, or like a copy of a bank statement or a retirement account. Basically, proof that you have the money to follow through with the purchase. OPM, other people's money. This could be bank money, private money, hard money, basically not your money. Hard money lender. Hard money lender typically, although not always, is institutional, meaning they're a business. They have a business. They're in the business of lending money, which usually means they have a set criteria. But that's not always the case. This can also be a private guy. I know it can be a little confusing, where basically think of hard money lending as someone who's going to lend you money, but it's going to be expensive. Private money lender. Same thing. The only difference is it's not an institution. It's an individual. That money can be very expensive, or it could not. They could have a rigid set of criteria, or they could have a very, they'd be open to criteria and look at different things. REO, real estate owned by the bank. Some common ones. For sale by owner, FSBO. They're selling the property without the aid of a real estate agent. Rehab is short for rehabilitation. Basically, you're going to rehab a property. You're going to rehabilitate it, do all the work to it. And then right at the end, I want to throw in a few Detroit/Michigan specific ones. Pre-sale inspection. This is the inspection you have to get done by the city of Detroit. prior to buying the house. And you need a pre-sale inspection. You get the ACR, which I'm not even going to try and spell, the affidavit of compliance responsibility. They don't do anything, think of it as tax. And finally, last but not least, SEV, state equalized value. If you look on the property taxes, your city assigns a value they think your property is. It's half. So if your SEV is $32,000, the state is saying, or actually the city, is saying that your property is worth $64,000. Phew! All right. How many minutes is that?
25.
25. I was going so fast too. I tried so hard. Sorry. You may have to watch this in increments. And you know what? I probably left half of it off, but this is 90% what you're going to hear. Now my goal was to get through it as fast as possible. But hey, if you're going to be in real estate and you want to be a real estate investor, you got to know lingo. So when you're at a, you're at a RIA and you want to sound, just because you're new doesn't mean you can't be educated and you can't speak intelligently, or at least if you're asking questions or you're speaking to somebody and they're throwing these, the ARV, this, the PA, the EMD, the POA, the CMA, the BPL, the NOI, the ROI, you actually know what they're saying. Because it sure helps when you're learning. Otherwise, it might as well be in Greek unless you speak Greek, which makes no sense. Anyway, that's it. I'm freaking exhausted. I just bored the shit out of you. But I hope it was helpful. Jim Burgess, Detroit Market Expert. Catch you guys later.